Thank you for joining us for this very special event. We have an exciting GoldSeek Live webinar this morning with several brilliant guests, company builders, and successful investors, which includes Jorge Ganoza, President, Director, and CEO of Fortuna Silver Mines, Rick Rule, President and CEO of Sprott U.S. Holdings, John Embry, Chief Investment Strategist at Sprott Asset Management, and last but not least, Doug Casey, Chairman of Casey Research. Our topics today are the gold market, silver and gold juniors, monetary policy, and where some of the top investors in our sector are putting their money now to set themselves up for some coming gains. We begin today's program by welcoming Jorge Ganoza, a proven mine builder, to our show to discuss his company, Fortuna Silver Mines. Welcome to the show, Mr. Ganoza.
Good morning, Vanessa. Thank you for the invitation.
Absolutely. Happy to have you here. Now, Jorge, the fact that Fortuna Silver Mines just reported net income last quarter means that you've done a good job of cutting costs. What do you think Fortuna does that other mining operators don't?
Well, over the last 5-6 years, we've been investing aggressively on our mines, on our operations, on efficiency, getting development ahead of production, optimizing. So over the last 2 to 3 years, with the drop in prices, we have been able to cut back on some capital projects without compromising our near nor mid-term future due to the investments we did in good days. And we have been also expanding our operations continuously, and we've been able to capture opportunities today, since our Kyoma Mine is at steady state, and San Jose is already, San Jose Mine in Mexico is already at a size of 2,000 tons per day. That allows us to capture efficiencies and opportunities. So our operating teams and the entire organization has been really focusing on efficiency at their operations, focusing on key projects only. And again, all of this without compromising neither our short nor medium term due to investments we did in the good days. So we've been able to drop our all-in sustaining cost in 2013 by 11% with respect to the previous year. And our projection for 2014 is that we're going to be able to drop our all-in cost 16% with respect to 2013. No? So our teams are doing an excellent job, and we're happy for that.
So you have plans to cut costs even further, down 16%?
Looking into 2015, we are seeing some deflationary pressures in the sector on engineering and services. So we will be looking to capture more of those opportunities. We believe that our mines have been optimized, or capital spending is optimized, although there is always room to look at operations with a critical eye. We are now perhaps looking more to capture opportunities on the services side, engineering services, and opportunities like that with more negotiating power.
Absolutely. Well, it's a great time to be building value with some of those deflationary pressures, as you were saying. Now, you've had some encouraging step-out drilling at the San Jose mine. What have you found there?
Well, we have found the extension of the main ore chute where we've been working for the past years at the San Jose mine. It's a discovery that has been evolving. It's been the evolving story for Fortuna over the last year and a half. And I believe the investors and analysts have picked up to this story, and are realizing the impact that this can have and is having on the company. These are not only, this is important not only because the rate at which we are growing our resource at San Jose, but also the fact that these are low-risk ounces. They are immediate to our area of production, where we already have a permitted mine, successfully operating, low-cost operation. We not only produce silver at Fortuna, we produce silver at a low cost. Again, these are low-risk ounces with a short term to production, and I believe the market has waken up to that over the last year.
Absolutely. How would you say some of these discoveries have been changing the project?
Well, when we built the San Jose mine, we made the decision back in 2010, late 2009. We had 5 million tons in total resources. No, if I pile reserves, resources, we had 5 million tons. Today, in total inventories, we have roughly 10 million tons. So the mine was originally conceived to be a 1,000 ton per day mine growing to 1,500. Well, we commissioned operations of this mine in September 2011. A little over 2 years later, we're already operating at 2,000 tons per day. And we have launched the engineering studies already to assess potential expansion to 3,000 tons per day. So the rate at which the resource continues to grow at San Jose due to the important exploration potential and opportunities that the property offers to us, it supports further expansion. Us thinking about a further expansion of it.
Right. Now, when do you think we might see some revised economics incorporating your new discovery there?
We have decided to take all of 2014. As I previously said, the mine was never conceived, it was not conceived originally to go beyond 1,500, and we're already at 2,000. So
right.
We need 2014 to conduct all the engineering studies, trade-off studies, to see what are our best alternatives to materialize this next expansion. We shouldn't shortcut a good engineering process. Fortuna has always delivered on time, on budget, and that is because we're careful planners.
Right.
And we're not going to shortcut that, so we're saying, we need 2014. So towards the end of this year, early 2015, we believe we should be in a position to make a definite call on the expansion and incorporate those engineering results and feasibility work in our figures and make it public.
Now as you said, you've been able to grow all the way up to 2,000 tons per day. And I guess my next question for you is how much more can the mine grow? And I think you mentioned potentially up to 3,000?
Yes. Ideally you want to explore the entire ore body and then from the start define what's the optimum rate of throughput for the mine and production. But this is a vein deposit, and we cannot escape that reality. No, this is a vein deposit. The opportunities to explore and grow the resource are marked by the characteristics of a vein deposit. So it has been, and it probably will continue to be, a bit of discover and grow, discover and grow. And again, we have been growing this resource at a very rapid pace. Just along strike, we have, we believe, 1.5 kilometers with surface showings supporting the idea that this ore shoot can grow that much along strike. So we need to drill it. We need to see. We believe the structure is there. What we need to see is that economic grade mineralization remain, or for what portions of that 1.5 kilometers that we see on strike length remain. But today it remains open, at least on 3 directions on the main Trinidad North zone, and the deposit, I like to stress, that remains open on the central portion of the deposit to depth. So we have multiple opportunities to continue growing the deposit.
Absolutely. And you could, because the deposit is so open and you're expanding the mill, you could potentially ramp up in 2015, you think, to around 3,000 tons per day.
Yes, and I also like to stress, with reference to your previous question, that we have a commanding land position around the San Jose mine. We roughly have 60,000 hectares of continuous mining concessions covering the entire area. And at San Jose, we're basically mining one ore chute in one vein. So there is plenty of opportunity for more discovery. We have already identified outside of the main Trinidad zone, the Trinidad Bonanza vein system, multiple other showings. We're right now focusing our efforts on Trinidad North, but we certainly have more opportunities, which I'm sure we're going to be capitalizing over time.
Absolutely. It's great to see high grade and wide widths and a deposit that's open to that extent, and sounds like you have an extensive land package as well. Now, how much exploration are you doing at Kyoma moving over to Peru?
Yeah, Kyoma it's a historic producer. No, the Kyoma mine has been operating for over 500 years. It's truly one of the historic mines in Peru. There is no shortage of drilling alternatives. We have cut the exploration budget for 2014 to roughly $1.5 million. What we're doing at the Kyoma mine is what I call surgical work. We are focusing our exploration on the discovery, aiming to discover high-grade bonanza-style chutes in some of the veins on the northern part of the district. That requires, surgical work, as I'm saying. So it's a modest program in terms of drilling meterage, but with potentially very high impact. No, the Kyoma mine is characterized by veins with bonanza-style mineralization. We currently have the Bateas vein where we're mining, on average a kilo per ton. It's small tonnage, but it's enough to improve and season the grade of our main anchor vein, which is the Bateas, the animal vein. So we have a modest budget this year, but we believe it's enough, and we have a sizable resource and reserve at this mine. So we're happy with the budget we have allocated this year.
Now, people have been waiting for Fortuna's next acquisition for a while. What do you think has been holding you back?
But I'd like to revert a bit back, because with respect to acquisitions, I think what we are focused is on growth. And there are two paths for growth: organic and M&A, inorganic.
Absolutely.
So we follow both paths. And at San Jose, over the last year and a half, we've been so successful adding ounces at a rate and a cost of cents per ounce that has no match. So the best way in which we can create value for our shareholders is on adding ounces per share, cash flow per share, earnings per share, and fueling organic growth the way we're doing is non-dilutive for shareholders, and is the best value we can bring. So, we are always keeping an eye open for opportunities outside the farm, I don't have to say that today our priority is exploiting the opportunities that organic growth presents to us at the San Jose mine, which are the most accretive to our shareholders.
Absolutely. And Fortuna stock's been trading recently around the 52-week high, up from below $3 at the end of 2013. What do you think has prompted some of these gains?
Well, again, over the evolving story for us for a year and a half now has been the discovery of the Trinidad North Zone and the growth of resources and the expansion of production at the San Jose mine. I believe the market is waking up to that. And, you know, year to date, silver is roughly up 4.5%. Fortuna shares year to date are up roughly 90%. No? So, you know, we are not only growing our resource, growing our production, keeping our costs down. So, you know, even in this environment, I believe the market is recognizing we can not only continue our business, but we can thrive. So I believe that we're being benefited with a sort of flight to quality when investors are looking to places where to invest in the sector. We are a good call on silver. No?
Right. The market's rewarding you for cutting costs, returning a profit in this kind of cost-cutting environment, and for all the organic growth that you've been able to do at the mine as well.
Yeah, and again, these ounces that we're bringing are not ounces that are, you know, 5 years ahead or you know, from now. Are ounces that you can look at them as fast-track ounces to production, low-cost fast-track ounces to production.
Great. Well, now, Jorge, we have a lot of audience questions coming in for you, and we're going to take a couple of them here. The first one we have is from Dave L., and he asks, is it possible that Fortuna Silver could withhold from immediate sales some of the silver produced at the mines? More specifically, is it possible to reserve for future sale some small percentage, perhaps 3 to 5% from current production?
Right now, it's not something we are contemplating. I'll say that it's not something we're contemplating at this moment. No, we sell our production and all of our production, and you know, we are in the business of mining silver economically. We aim to be one of the lowest cost producers that can make money and thrive in a high price environment as well as in a low price environment.
Right.
We believe the fundamentals for higher silver prices remain, but we do not see as a strategy or short-term financial management the need to withhold silver.
Great, and we have another question from Mark in Florida, and he's asking, is Mexico still a competitive and silver mining friendly country in your opinion?
The short answer is yes.
Yeah.
Even I'd like to add that even you know, Peru and Mexico are the two jurisdictions the two countries where we operate. And certainly, if we compare Peru and Mexico today with 10 years ago, they're more difficult. But tell me what place has gotten easier? So on relative terms, and that is what we have to look at when we compare jurisdictions for asset allocations and project searches. We believe these two are still the best mining jurisdictions in in Latin America.
No, that's fantastic. Well, just as we wrap up here, Jorge, I'd like to take this moment to thank you for joining us, and congratulations on reporting net income last quarter. Thank you for joining us and answering some of our questions. And to learn more about Fortuna Silver Mines, Fortuna trades on the NYSE under the symbol FSM and on the TSX under the symbol FVI. And you can go to the website for more information as well. So thank you so much for joining us this morning, Jorge, and we look forward to having you back again soon.
Thank you, and thank you to your audience for your time.
Absolutely. Great. Okay. Well, our next esteemed guest that we're welcoming on the show this morning is Rick Roll, President and CEO of Sprott U.S. Holdings, or CEO of Sprott Global Resource Investments. And we welcome you to the show this morning, Rick.
Thanks, Vanessa. It's always a pleasure.
Great. Now, Rick, when we last spoke, we discussed the ability of mining companies, to cut costs. We were just speaking with Fortuna Silver Mines, and I'd love to hear what you think, the company's done, what kind of job that they've done in cutting their costs and keeping production costs low.
Well, I congratulate you for selecting Fortuna. The Ganoza family, who operates Fortuna and also a sister company, Atico, are, as you've pointed out on your webpage, he's the fourth generation of his family in mining. They have a engineering background, really, rather than a financial background, and they have this wonderful old-fashioned sense that miners should be able to turn rocks into money as opposed to turn rocks into stock and stock into money. And the achievements that the Ganoza family has made, initially in Peru, but then, of course, putting the San Jose mine, which other people failed to put into production, while also building a base metals mining business in Colombia, it demonstrates, I think, their expertise at smaller, high-grade, what used to be private operations in Latin America. And I think they've demonstrated that despite the fact that the industry has a tough time controlling their operating costs, that skilled owners who are involved in businesses that are very familiar with them, as opposed to generally familiar with them, can survive and, in fact, thrive in difficult times. And I think the Ganozas are an example to the mining industry worldwide about the need for renewed focus on operations and a much more rigorous approach to both operating and general and administrative costs.
Right. So you could see them as being somewhat of a, model management team in terms of taking the initiative and cutting costs and in this environment.
In terms of operational efficiencies, yeah. Absolutely. And of course, their investment strategy was intelligent. Rather than cast around the world looking for things, they decided that the most upside they had on a per-share basis, and it's important to remember this, they and all the good mining guys are anti-dilutive. They decided that really brownfields exploration in San Jose, taking the San Jose deposit from 5 million tons to 10 million tons, while preserving the grade and allowing them to accelerate throughput, was the right thing to do. It's the type of investment risking that the industry needs to do more of. That isn't to say that the Ganozas are the only people who are making improvements. Far from it. But it's nice to see somebody. It's nice to see groups. It's nice to see good guys win. Let me just say that.
Right. Well, I think you mentioned last time as well. There were some other great, groups, the Lundin Group and Robert Friedland, who are just building incredible value in this market.
I think that's right. All in different ways. I wouldn't. Right. They do things differently. The Lundins actually. I wouldn't say they have Ganoza in them, but they do have the ability to hire good people. And the Lundins very much have a focus in their operating companies of trying to effect incremental improvements every quarter so that you build improvement on improvement on improvement. And, they do it in a different level in a different business than the Ganozas, and the Lundins don't do it directly. They have people who work with them and for them who do it. But there's that same relentless focus on marginal improvements in operational efficiencies on a quarterly basis. They do a very good job. Robert, of course, Friedland isn't in production yet, so he doesn't have any operations to marginally improve on. Robert's defining competitive advantage, I think, first of all, is intellect and communicative skills. He is the best promoter that I have ever had the good fortune to face. I mean, the best. He hires very high caliber technical people. He holds them to a very high standard. which is why where most of the rest of the world is drilling old, used, has-been deposits and not finding much, Robert has literally caused his people to push the frontiers of science in terms of remote sensing and other things, and has been rewarded with an enormous platinum discovery in South Africa and an enormous copper discovery in Congo. He did take one retread, that was the Kakushi zinc deposit, but the retread he took is of a medium-sized mine, the highest medium-grade copper zinc mine in the world. So if you're going to take a retread, you may as well take the best on the planet.
Absolutely. Well, I think last time we spoke, we also talked a little bit about the summer of 2000 and how issuers really reached some of those market clearing prices that you mentioned. Do you think we're close to the summer of 2000?
You have a very good memory, Vanessa. We haven't seen either the capitulation sell-off or the wholesale issuer capitulation that we saw in the summer of 2000, which is one of the reasons why the recovery that we're in, while heartening, will be more saucer-shaped than V-shaped.
Okay.
This has helped the market, frankly. For reasons of personal convenience and because of the extraordinary success that we enjoyed in the 2000 to 2005 timeframe, I would have preferred capitulation selling. I would have preferred being able to allocate all of the capital that we raised, because we raised a lot of capital in bad markets, at market clearing prices with great big fat full warrants, just like what happened in 2000. This hasn't happened, which means the recovery will be postponed because the cause of the recovery, in addition to a snapback from low prices, will come from advancements at the project level. And in order to make advancements at the project level, the best guys in the industry need to raise and employ more money. And so until that's done, we can't see a real stout, firm turnaround, but we will.
Now, what shape do you think the junior market is in right now? Are you excited about junior mining plays?
Yeah, I'm quite excited. I think we're at an interesting phase. We're at a phase where the market can't help but exceed expectations because expectations are so low. The difficulty with regards to expectations is going to be to get under the bar, not over it. And that's one of the ways that these bear market bottoms turn around. Companies exceed admittedly abysmal expectations. That in conjunction with things like the M&A that we're beginning to see, the acquisition of Papillon by B2 as an example, that does three things. First of all, there was that wonderful surprise. It was a good surprise. The takeover adds both liquidity and hope to the market, but more importantly, it was an intelligently constructed takeover so that at the same time the Papillon shareholders benefit, the B2 shareholders begin to have a very stable vision of how B2 maintains its growth. It reminds me of the acquisition back maybe in 2000 of Francisco Gold by Glamis. Everybody was saying, well, how's Francisco going to get built? Well, when Glamis bought it, that was the end of that discussion. At the same time, the market was wondering how Glamis was going to continue to grow. And the acquisition of Francisco by them answered questions for both shareholders. So you had a takeover to 50% premium, and then the acquiring company's share price doubled. I'm not saying that that's going to happen with B2. What I am saying is that the surprises that we're going to get in this market from the better companies are going to be positive. There is going to be M&A that goes on, which is positive from adding both hope and liquidity to the market, and it's going to be intelligent, strategic M&A, unlike the M&A that we saw in the last decade, which means that the acquirer stock will go up too. That's the way you blow out of these bear markets, and that's what's going to happen this time.
Now, do you think this downturn is, different to ones you've seen in the past? Are there some, fundamental shifts happening?
Well, everyone has been unique and interesting. What has amazed me about this one has been its savageness. If you think about a decent-sized index like the TSXV, which is really an interesting composite, if you think about an index like that, the resource index, falling by 75%, that's a fairly savage bear market. It reminds me of the related bear market in Russia. you know, where the market's off by 50%, then an event happens in Ukraine and it's off by 35% on top of the 50. These are special, and they're special in every regard. So one way that this decline differs from other declines that I've experienced in my life has been just its very savageness. And frankly, it would be good for the market if that had lasted a little longer. If we could have scrubbed 1,000 listings out of this market, the worthless listings, the comeback that we would have experienced would have been much more dramatic. That purging did not and has not happened yet.
Right. We could have, if that purging had happened, maybe see a savage bull market.
Yes, exactly. I mean, I remember very well the market recovery in the early 90s, where prior to that, literally a dozen listings, sometimes 2 dozen listings a week would get suspended. And when the market turned around on the diamond discoveries in the early 1990s, there was literally a shortage of paper. People wanted to be in the junior resource market, and there wasn't enough paper for them to buy. Now, we have extraordinary paper creation capabilities now. I don't see that shortage existing for any duration. But I think it would have been useful to scrape away, you know, the bottom end of the petty dreadfuls, and that hasn't happened yet. Maybe they'll all go in the marijuana growing business, you know.
Yeah, exactly. That seems to be the next big thing. I'm wondering, I've heard a couple of speakers talk about diamond companies, and I'm wondering if that's something that, you know, you just mentioned the diamond market in the last downturn. Is that something you look at Sprott?
We participated in prospect generation, which means that some of the diamond prospect generators, including one that was you know, affiliated with the Lundins, Lucara Diamonds, we were large shareholders of. My part of Sprott, I can't speak for Toronto, my part of Sprott is interested in the diamond business, but we wouldn't describe ourselves as having competitive advantage relative to other money managers in diamonds per se.
Okay.
And the consequence of that is that we don't focus on it. You know, we believe that we have technical expertise relative to other managers in several other resource segments, but diamonds wouldn't be among them.
Right.
Doesn't mean we wouldn't be tempted, but it's distal to our, you know, core franchise.
Yeah, we just saw palladium actually reach a 13-year high. I think it touched, was it 867 or 868? Why do you think that was?
Platinum and palladium are unlike other precious metals in that they're simultaneously really industrial metals. And what's happening in the palladium market is simply the market's reaction to a shortage. It has more fabrication utility for dollars spent than platinum because it has similar applications, but it's cheaper. And we believe on a global basis that the amount of finished platinum and palladium ready for fabrication or investment processes constitutes less, perhaps well less, than a year's demand for fabricated platinum and palladium. The platinum and palladium prices have been held down for some years by a surplus, and we think that surplus is being eaten through. It's very obvious to the market that on a global basis, the platinum and palladium business does not earn its cost of capital at this price. So the idea that a necessary cushion of finished metal to satisfy the auto catalysts and you know, other demands for platinum and palladium, the idea that that surplus could return is nonsensical at this price point. The industry doesn't earn its cost of capital at this price point, so obviously production won't increase. And the recent strikes that you saw in South Africa really are a manifestation of this problem. The palladium price is up, I think, because the strike itself focused the financial services industry on the odd conundrum that the workers' wages had to rise. They were deplorable. And they couldn't rise because the industry didn't earn its cost of capital. The political reality in South Africa is that the government wants to maintain shafts that are unprofitable at these price levels because they can't afford to have 60,000 more unemployed platinum workers, and the industry can't afford to pay them. These shafts will shut down and the price will go up, or the price will go up and the shafts won't have to shut down. But assuming that there's ongoing demand for platinum and palladium, the price has to go up because the industry does not produce enough platinum and palladium on an annual basis to satisfy existing demand, and demand is rising for higher quality air and for the use of platinum, palladium, and autocatalysts worldwide. So the increase in platinum and palladium prices is simply the fact that the market has woken up. They haven't even had to do math. They've just had to do arithmetic.
Mm-hmm.
And that's
Right. Well, speaking of the market waking up, do you think we're getting any closer to issuers reaching some of those market clearing prices in order to have the terms to attract some of the smart money?
Well, they seem to be attracting money without market clearing terms. Time will tell whether the money that they attracted was smart money or dumb money. I don't know the answer to that. But there is an upturn in financing, and there's certainly an upturn in interest in this market from investors and individual financiers. And there's, as you've seen, an extremely buoyant amount of money available to mining companies from the private equity space for mine development. There's going to be a real upturn in non-traditional financing for these companies, joint venture financing on a project basis, because there's so much private equity money around.
Right, and we're seeing, the market is voting in some cases on some of the better companies that have been able to cut costs and turn profit. Why do you think we haven't seen more consolidation, and is that coming? I mean, we've seen some big ones, but
that's a great question. There's two reasons. Well, they're both one reason. And that would be executive intransigence and greed.
Okay.
Nobody wants to lose the last man standing contest. They all want to be the surviving CEO, and they want their team to survive. And in a merger, the reason for a merger is to lower general administrative costs, not increase them. The second thing, and this is one of the great unspoken sins of the TSXV, it's related to the first, the premiums that managers are writing into their employment contracts for change of control can add 50% to the cost of acquisition. We saw a company not too long ago with a $15 million market cap that had $7 million in change in control provisions. So that in the event that there was an amalgamation, the departing management team would walk away with about a third of the total consideration paid at that market cap level. That's unconscionable. And the fact that companies get away with that is really because investors abdicate their governance role and don't look at the management information circular and the proxy information. I mean, that's shameful.
Right, absolutely. And you have to, as a company, your duty is to protect the shareholders and reward them.
And the shareholders' duty is to protect themselves by reading the information and voting these
Very
bonds.
true. Very true. Well, speaking of educating yourself, you have this major symposium coming up in a couple of weeks here in Vancouver, the Sprott Symposium, and I wanted to ask you what this represents to you, Rick, in terms of the development of your career. This looks like an incredible invitation list. You've got people you've been making money with for the last 20 years. You've got a speaker such as Robert Friedland, who you noted in this discussion to be, one of the world's greatest mining promoters. How do you wrap your head around all of this?
Well, Vanessa, I've been speaking at other people's conferences for about 30 years. My wife and I did our own conferences about 20 years ago, and then sort of left the conference business because it's hellishly hard work. This conference, the Vancouver conference, was ably started and run by Agora Financial for 16 years. And I think really, if the truth were told, Agora's abdication of this conference has to do with the decline in natural resource markets. For them, they began selling more subscriptions in technology, and a resource conference was sort of counterproductive. So they decided after 16 years of running the conference to abandon it, and encouraged me to take it on, which I have done. It's been interesting for me in the sense that, I got to have a hand in the speaker list as opposed to being a speaker in somebody else's conference. But most of the basic things that Agora did with that conference, and by the way, in its time, I felt it was the finest microcap resource conference in the world, which is sort of a high bar to get over. But they made several important decisions, one of which was that to recognize that the attendees regarded exhibitors as content. Conference promoters regard them as revenue. And many of the conferences have selection criteria for exhibitors that are about as strenuous as a driver's license and a check that cashes, maybe even a pulse and a check that cashes. And Agora took a very different point of view. Agora took the point of view that its keynote speakers had veto power over exhibitors because the exhibitors were content too. Now that doesn't mean that every exhibitor at this conference is going to grow up and become BHP.
Right.
What it means is that there is a unanimity of opinion at Sprott and among the speakers that this company has legitimate prospects and has legitimate reason to be at a legitimate high-end conference. And I think that's very, very, very important. The other thing that people need to know about this conference is, having now had a 17-year history, the attendees themselves are often wonderful sources of information and opinion. The idea that a room full of 500 rich people who are spending good money to be there and care about their investments, the idea that all the knowledge in the room flows from the dais to the crowd is stupid. Mm-hmm. There's a huge interchange of knowledge, and exhibitors have told me that they have benefited mightily from talking to other other attendees. Right. Certainly, our ability to attract Robert Friedland, who is, when he is on, an amazing public speaker. And yeah. I'll be doing my best before he goes on to fill him full of coffee and emotion so that he gives a great speech. I'm very excited about bringing somebody of Robert's caliber. Somebody who
Absolutely.
built a $2 billion fortune in mining from a standing start. That's an impressive achievement.
Yeah, and I've heard he's, even credited with imparting the reality distortion field to Steve Jobs. There's a lot of reasons. I'm very excited to see him speak at the show, and you're going to be speaking there, as well as another panelist, Doug Casey. And there's quite a lineup, I think, between 20 and 30 speakers. So very excited for that,
yeah.
And that's July 22nd to the 25th.
At the Fairmont Hotel, Vancouver. Your listeners are welcome to come on our website, which is www.sprottglobal.com. You'll see information concerning the conference right on the front page. Click on it. You'll get all the information you need. I'd love to see more people in Vancouver. It's a wonderful conference.
Excellent. Well, Rick, I'd like to thank you for joining us this morning, and thank you so much for sharing your insight, and look forward to our next interview at the Sprott conference.
Vanessa, thank you very much for having me, and I do look forward to being interviewed by you at the Sprott Vancouver conference. It's always a pleasure.
Okay. Thank you, Rick.
Thank you. Bye-bye.
All right. So our next
here,
guest,
John Embry.
Hi, John. Welcome.
Thank you very much.
Our next guest is John Embry, the Chief Investment Strategist of Sprott Asset Management. And we're very thrilled to have John on the show this morning. Excited to talk about the gold market, and we'll get right into it. My first question for you, John, is you've been an advocate of holding gold as a hedge against some kind of black swan event that could potentially happen in global currencies. What kind of black swan event do you think could happen?
Well, I think there's any number of them. I mean, in a world that's just awash in debt, and I mean, it's just not the United States with its hundreds of trillions of unfunded liabilities and what have you. I mean, it's virtually every country in the Western world, and China for that matter. And as a result of this, as far as I'm concerned, that the idea that there's going to be a tightening up of the system is ridiculous, because if that were to happen, this debt load would sort of fall in on our heads. So consequently, I see just more and more money creation at virtually every country level, and the effect of this will be the debasement of paper money, and it will probably gain speed from here. And in that event, I mean, to me, gold and silver are real money and have been for centuries, and they are your alternative to these paper currencies, which in my mind are doomed.
Right, and what do you think could potentially trigger some kind of black swan event
Well,
like this?
there's so many things. The area that particularly concerns me is derivatives. As I think the listeners are well aware, there's something north of $1 quadrillion worth of dollars worth of derivatives in the system, the vast majority of them held by the large global banks. And a good percentage, in fact, a majority percentage of these are related to interest rate swaps and the like. And any sort of violent change in interest rates could sort of trigger a disaster in this field, which I would suspect might bring the whole banking system down. That's one of the reasons why you're seeing the central planners trying so desperately to sort of keep interest rates zero-based and keep them as low as possible, because any volatility emerging in this area, I think, could detonate the derivative bomb, and then the problem might just get totally out of control. That to me is probably the most likely catalyst, but there's any number of others. I mean, you saw last week there was an Austrian bank issue. You could have a banking issue somewhere in some country that could get it all started because they're all globally interrelated.
Right. Well, and Janet Yellen recently said she didn't favor, raising interest rates, which is just what you're saying. They'd like to, or they need to keep it at zero.
Well, I think it's fascinating because these the Federal Reserve governors are kind of playing a rope-a-dope. Some of them come out and they say that rates are going to be going up, and then someone comes out 2 days later and says, no, I think we'll hold rates here. I think they're trying to use moral suasion to kind of keep things under control, because there's nothing they can really do other than provide the necessary liquidity to keep this from imploding. But they can't admit that, because if they sort of acknowledge that they had to keep pouring more and more liquidity into the system, somebody is going to wake up to the fact that holding this paper with these ridiculously low interest rates, you're the sucker at the table because you're going to get crushed. These things aren't going to buy anything when this is over. So
absolutely.
It's an interesting game they're playing, but they don't really have many alternatives. If somebody said to me, what would you do if you were the head of the Central Reserve, or Federal Reserve, I wouldn't be doing a whole lot different, because they've been handed a situation to which there's no solution.
Right, so if you were in their shoes, you would be doing the same thing.
Well, it's an interesting question. I'm a huge believer in Austrian economics.
Right.
And basically, you can either take the pain now and create the debt deflation and start over again, or you can continue to do what we are doing now and creating whatever liquidity is required to keep things afloat. And this will ultimately, when the velocity of money accelerates, and it will accelerate in the future at some point, lead to some form of hyperinflation, which I submit is a worse outcome than a hard deflation, because it just sort of prolongs the agony, and it destroys society as we know it. So really, if I were in charge, I would take the pain now, but I'm not in charge, and nobody will do that who is in control, I don't believe.
No, it's interesting because it seems as though, between the lesser of two evils, central planners tend to prefer hyperinflation because at least they feel that they can control it, whereas deflation and deflationary spiral, you could perhaps break it by raising the price of gold overnight like they did before. But when you've got to choose between the two, it's a difficult choice.
Well, I think there's another aspect to it, and that is the fact that, America is continuing to lead the world economic and financial scene, although I think that is a limited shelf life. But the fact is, the last great economic disaster in America was a deflation, like the Depression. They haven't had a history of hyperinflations, so they don't perhaps understand how damaging they can be. So they take the easier route because it stretches things out, but it will end very badly, in my opinion.
Right. Now, you mentioned a debt bomb. The stock market gets a lot more attention, just in the media than the bond market, which is much larger in size. But what's happening there? And is there any room to profit in bonds these days?
Well, anybody that's tried to be short bonds has probably lost money, but there's going to be a period that being short bonds is going to be seen as genius. The very fact is that if what I just said is correct and that the central planners will continue to create whatever liquidity is required, I mean, you are going to have a situation in which these bonds are going to lose their purchasing power at an alarming rate. And at some point, people are going to sort of collectively realize this, and they're going to part company with them. And so consequently, I mean, stocks are different because in many instances, they represent real assets. And under a sort of when money is being destroyed, real assets are what you want to own. So if you put a gun to my head and said you want to own a stock or a bond, I'd say clearly a stock. But what you have now is sort of like a bubble in stocks, and they haven't differentiated between the kind of stocks you might want to own in a hyperinflation and just stocks in general. So I think there's still a lot of risk in stocks, but I prefer them overall to bonds.
Right, okay. Well, moving over to the paper gold market, what's wrong with the paper gold market today?
Well, I think the paper gold market is the biggest Ponzi scheme in mankind's history. Quite frankly, I believe these numbers where they say there's probably at least 100 claims on every available ounce in the Western system. And there have been people who are in that acknowledge it. And consequently, I think that at some point there's going to be a recognition that the very time you need your gold is going to be the time that you realize you really don't have gold. You have a paper representative of gold. And what will happen is that when push comes to shove, these paper gold products will be settled in paper, which is the exact thing you do not want at that moment. And I would think that would trigger at the margin a huge shift into trying to buy physical, of which there will be very little available, and the price will go berserk.
Right, right. So you could see the price going parabolic.
I see the price, once it breaks out of this stranglehold it's been under for the better part of 3 years now. I mean, that's gone from 1900 to the current 13 and a quarter. When it breaks out, I think its return to 1900 to new highs will be very rapid. I mean, I'm still of the mind it could happen before this year is out. And once you get sort of beyond the all-time highs in gold and silver, I think that then the upside is open-ended, as basically it's not gold and silver that are really changing that much in value. It's the value in what the paper in which they're being denominated.
Right. And why do you think there isn't more oversight in the market?
Well, very simply, I think there's been basically a suppression of the gold price. I see the central banks. This is the central bank's worst nightmare, gold, because it essentially constrains their power. So it makes tremendous sense for them to sort of constrain the price and to keep the public in the dark. And I mean, I find gold and silver, for that matter, at this point, to be undervalued, underowned, and most assuredly underloved, because the average person hates it because of the price action in the last 3 years. And they're wrong. They will be proven wrong, and when they realize that they're wrong, it'll be too late to get in because the price will be moving like a scalded cat.
Right. What do you think's been happening in the last month with gold? You know, if
that's a good question, because there's clearly a change in the tone of the market. As you're well aware, every major bank in the world, with the possible exception of Citibank, is calling for much lower gold prices. I mean, all you read in the mainstream press is stuff dissing gold, and yet, and there's been a huge open interest developed on the COMEX. I mean, the huge short position by the commercials, which is often sort of thing to frighten you because they generally take it down in that event. But every time they try to take it down for the last month or so, it just keeps bouncing back. And I consider that to be a really good signal, because a market that won't go down will ultimately turn around and go up. And in this instance, I think quite violently. So there has been a distinct change in tone in the market in the last month, which is totally at odds with sort of what is being sort of pushed in the mainstream media, which is basically still very negative in gold.
We have a lot of viewer questions coming in right now, and I think I'd like to share one because it's pertinent to our discussion at the moment. We have one from viewer named Palmer. As of a year ago, I decided to save only in gold and silver. So with every paycheck, half goes to physical gold and silver, and I only keep enough cash for living expenses. Am I crazy and eccentric as my relatives think I am because of this decision? Everyone I personally know thinks that this is very weird. Thank you.
That is a sensational question, because I was having dinner with a friend last Saturday night who is in the same position. I mean, he's a great advocate of gold. He's been putting a significant proportion of his net worth into gold for the last couple of years, and every single person he knows who are conventional thinkers think he's crazy. Mm-hmm. Well, I think that basically I've always made most of my money by being a contrarian. This is one of the great contrarian investments, and as I said, it's underowned, undervalued, and underloved. I think the situation is setting up for one of the finest investment opportunities, and I think Palmer is going to be able to have the last laugh on all this.
Absolutely, I agree. We have another question. Guna from Malaysia asks, since China and India are the biggest consumers of gold, would they move the price fixing to Shanghai or China to have the free flow of pricing based on demand?
I think that that is inevitable, because when the paper gold market blows up, and I firmly believe that's going to happen, I think price discovery will become more physical, and the Shanghai market basically would be a natural outlet for this. And as well as that, as you well know, I mean, a significant proportion of the West gold is already migrated to the East, to India, China, and the like. And I'm a firm believer in the idea that the Chinese will basically ultimately back the yuan with gold, and when that decision is made, they'll mark the price up dramatically because they'll have most of it, and basically it will be a very bad time for the West. And as a Westerner, it disappoints me greatly what's transpired.
Mm-hmm. Our next question is from Michael C., and he asks, when will the physical market break away from the paper market that is controlling the price? When do you see that happening?
That is a terrific question. And I would say we can't put a date on it because we don't know how much gold remains in the central banks in the West and how much gold they can access at these levels to keep the price way below where it should be. My impression is that we're reaching the end of the line. And if my price projections over the next 6 to 12 months are correct, it would require that event happening, that the physical market would start to take precedence over the paper market. And so my answer would be, I would be extremely disappointed and surprised if it didn't happen within the next 6 to 12 months.
Okay, next 6 to 12 months. A question from Ron, and he is asking, given the huge short positions in gold held by JP Morgan, how does this reconcile with future trends? Is this position, which I understand is backed by the Feds, an effort to hold gold prices back?
Well, I don't think there's any question. I mean, there's been great debate through the years, and as some of the listeners might know, I wrote a paper on this subject about 9 years ago with my associate. So I've been a great believer that the gold price has been manipulated aggressively, and if anything, it's picked up. And I believe that it's well acknowledged that JP Morgan is the U.S. government's bank. So the fact that they are running a large short position, it doesn't particularly surprise me. But I think, as I said earlier, as sort of the gold market shifts away from the Western world and the pricing aspect moves to the East, well, then I think that this short position could become a real damaging position for JP Morgan and the other banks that are maintaining short positions. I see this as a potential huge positive going forward because, I mean, basically shorts have to be covered. I suspect they'll be covered in paper, but nevertheless, they're going to have to be covered, and that'll push the price up.
Now, just with regards to the manipulation in the gold price, what have you been seeing lately?
Well, I think of anything, the manipulation has become more frantic and more blatant out in the open. Like, I think 95% of the time, and when the access market opens in the evening, the gold price has been dropped, sharply right at the outset by, high-frequency trading and what have you. This, to me, is, last gasp type of behavior, and that's why I'm so encouraged by the recent action of the price and what I think is coming. But manipulation, one of the underlying reasons for it, I believe, is that if the gold and silver prices truly reflected what is happening in world monetary policy, interest rates could not be maintained anywhere close to zero. They would rise sharply because the paper holders would realize that, you know, inflation or potential inflation was becoming a huge problem. So, I mean, I can understand why it's being done, but you can't sort of dispute reality forever, and I think we're coming very close to the end of that period when this is going to be successful. And even if they weren't being manipulated, I can give you an extremely bullish case. The fact that it has been manipulated just makes the case that much stronger because the price is lower than it should be.
Right, and so you're seeing signs of, you know, a lot of physical supply shortages in silver and gold.
That we are convinced that is becoming evident. But I will never say that the bottom's in the paper market because they might be one last spasm to the downside. But what we're talking here is there's so much open end in the upside. I mean, you're talking thousands and thousands of dollars in the upside, and you're talking maybe, let's just be negative and say 100 in the downside or something. It's a risk-reward ratio that is heavily in favor of reward, and I think the percentage chance of the reward coming right against the risk is about 9 to 1. So am I worried about short-term downside? No. I think everybody should be focused on the upside, and the fact that very few people are makes it an even better trade.
Absolutely. Well,
trade. It's not a trade. It's an investment.
Right. Well, it's tough to be a contrarian, you know, when everyone is
I've been one all my life,
suit.
and it's made me a lot of. So at my age, I'm not going to change.
Right. Well, John, I'd like to take this time to thank you so much for joining us today. It was fascinating speaking with you. And you can subscribe to Sprott's Thoughts to see more commentary from John, and go to sprott.com to find features and articles by John Embry. Thank you so much for joining us today, John.
My pleasure, anytime.
Okay, great. Well, we're going to welcome our final guest this morning. Last but not least, we have Doug Casey, Chairman of Casey Research, and we're thrilled to have you joining us today. Welcome, Doug.
Thanks. It's nice to be here. Well,
great. Now
I'm an Aspen. I don't know where you are.
Just here in Vancouver, Canada, and our team, some of our team is also in Colorado, so we're a little bit spread out. Well, we're going to talk a little bit about the markets and monetary policy. And, you know, the Dow recently topped 17,000 points for the first time, pulled back a bit and reversed from that slightly. But how sustainable do you think this is?
Not very, in my opinion. The reason that all these markets have been going up is because governments all around the world, the U.S. government, the EC, the Chinese, the Japanese, they're creating trillions of new currency units. And those currency units have to go someplace. And a lot of them are going into the stock market. Even more of them have been going into the bond markets with interest rates at all-time lows. So it's unsustainable at this point. Well, that's not to say that the Dow couldn't go to 40,000 or 50,000. You can pick any number at all. But if inflation gets that bad and they create that much money, it's going to have really severe effects on the economy at large. So I have no interest in the stock market at large right now because by all historical parameters, it's just too expensive, number one. And number two, the economy's on the edge of a precipice again when earnings could collapse. So no, count me out of the stock market.
Right. And with stock market valuations, you know, being so inflated, are you shorting stocks?
No, I'm not doing that either because I don't want to, as they say, fight the Fed. I don't want to stand in front of an onrushing freight train. So I'm on the sidelines.
Right.
This isn't, in other words, the stock market today can't be said to be in the same position that the tech market was back in 2001 when that was clearly a bubble. It's,
okay.
And it's driven by other factors. So, you know, there's sometimes when you want to be long for sure, sometimes short for sure, and other times be out of it. And I don't think you should be in the market in anything unless you think, at least in your subjective opinion, the chances are large that you're right, and if you're right, that you'll make a multiple on your money. So this is one of those times.
Now, you've also pointed out that there's a heightened risk of a bond market collapse, and we were just talking about that with John Embry a little bit. How likely do you believe that outcome would be?
I think that the bond market right now is one of the great bubbles of all history, and it's just an accident waiting to happen. I don't understand why people are chasing bonds. I mean, Treasury bills are yielding pretty close to zero, and even the so-called junk bonds are only yielding 4.5% or 5%. This is amazing. If you look back to the early 80s, you could get Treasury bonds that were yielding 15%, and T-bills that were yielding 18%. So how short people's memories are. So in fact, that would be a fantastic short if you want to play in the market and you have staying power, because I don't know if the market's going to stay, if it's going to stay irrational for another day or a month or a year, and you can get hurt in that time. But when the bond market rolls over, it's going to be just catastrophic, because we're talking about scores of trillions of dollars that are going to be wiped out when interest rates go up.
Right. John Embry was also saying that you know, being short bonds, you know, could be seen as genius. So it sounds like you're the same. Bonds
are a triple threat to everybody's capital. Number one is the interest rate risk, and with interest rates at all-time lows, bonds are at all-time highs. So that's number one. Number two is the currency risk, because bonds are all priced in the national currencies of one government or another, dollars, yen, euros, what have you. And all of these currencies are headed towards their intrinsic value. And number three is the default risk, that you might not even get that money back in the currency, certainly if you're buying corporate bonds. So that's why I call bonds at this point a triple threat to your capital.
Right, and when you say currencies are going to their intrinsic value, I'm assuming you're thinking zero.
Yeah, I am, because they're nothing but accounting units at this point. They're backed by nothing but confidence in them, and confidence can blow away like a pile of feathers in a hurricane.
Right. Well, Janet Yellen recently said that she wasn't in favor of raising interest rates. So, you know, what does that mean for the economy and the U.S. economy and for gold prices?
Well, first of all, it's incredible to me that anybody pays attention to what these silly bureaucrats say. The Federal Reserve, none of these central banks should exist, quite frankly. They serve no useful purpose in an actual economy, but people think of them now as being part of the cosmic firmament, and they actually take them seriously. So here we have the opinion of this nice old grandmother as to where interest rates should be. It's completely ridiculous. The interest rates, like all other prices, should be determined by the market, not by some silly woman. She'll be lucky if she's not strung up by her heels from a lamppost if the economy collapses badly enough. Although that would be rather unseemly for a grandmother, but anything can happen, of course.
And, you know, what other indications has she been giving about the Fed's policies?
Well, I don't really pay much attention to her, because this is the whole idea of the Fed setting interest rates and controlling the economy. It's an accident waiting to happen. It's foolishness. It's based on Keynesian economics. So it's like listening to the pronouncements of a bunch of medieval astrologers, alchemists. So I'm befuddled by the fact that anybody takes these people seriously and respects them.
Mm-hmm. Well, how possible do you think it would be for the Fed to fully phase out QE?
Well, I think they're trapped at this point, because if if they don't keep printing up money, what's going to happen is a deflation. Now, in my opinion, a deflation would be a good thing. There's only two ways for this whole charade to end. One is with a hyperinflation where they keep printing up more and more money at faster and faster rates, or they stop printing up money, and all the people that have taken advantage of these things and indebted themselves because low interest rates make it prudent, wise to indebt yourself. Either you have a catastrophic runaway inflation or a catastrophic deflation. So at this point, they're in between Scylla and Charybdis, and it's too late to turn around, in my opinion. So I think they're going to keep printing up money is what I think is going to happen.
Right, so they're just doing more of symbolic tapering.
Yeah, and I think when things get rough in the economy, in other words, right now as we speak, we're very much in the same position, I think, that we were back in 2007. And the economy nearly fell apart. Nearly all these banks and brokerage firms and insurance companies nearly collapsed back in 2007. Now, in my opinion, that should have happened. That would have been better. Then we'd already be on the other side of the disaster at this point. Well, if the government didn't do something even more stupid. But all of the world's central banks have basically shot their arrows by printing up trillions of currency units in the last few years. And what are they going to do when the economy gets bad again and the banks get more trouble? Are they going to print up hundreds of trillions of currency units? Well, I don't know, but it's going to be ugly, and we're right on the edge of it.
Right, they're going to be out of arrows.
Right.
To shoot. Now, what do you think that would do to gold prices?
Well, I'm a huge believer in gold because it's the only financial asset that's not simultaneously somebody else's liability. So I think that at some point there's going to be a panic into gold. At this point, gold is reasonably priced. Back in 2001, when it was trading at around $260 an ounce, it was actually cheaper in real terms than it was in 1971 at $35 an ounce. So since then, it's gone up about, 5 times in value. So I think it's a very good buy at this point. It's reasonable. It's not a giveaway the way it was 12 years ago. It's a very prudent holding, and I buy it consistently. I was listening to what John was saying about price suppression, and although I agree with just about everything that he said, I think that this meme about gold price suppression that's been circulating is essentially nonsense. And it's counterproductive to talk about it because most serious financial people think it's rather laughable that the government doesn't even care about gold. They really believe their own propaganda that it's a barbaric relic. So they really don't care about it. Would they like the price of gold lower? Sure. They'd like the price of silver lower, and lead, and corn, and soybeans, and copra, and jute, and every other commodity lower. But they don't spend any time or attention controlling the price of gold, entirely apart from the fact that it's impossible in today's world. Even back when there was the London gold pool in the late 60s, when there was only 3 billion ounces of gold in existence. Now there's probably about 6 billion ounces of gold in existence. And back in those days, governments were much more powerful than they are now. They couldn't even keep the price of gold at $35 an ounce back then, back when governments owned most of the gold in the world. Now governments don't own it. There's much more gold in the world. It's much more higher price. Governments are much weaker. They can't control it, and they don't care about it. Like I said, they believe their own propaganda. But that said, I think gold is going much higher for fundamental reasons.
Right. Well, manipulation is definitely a controversial topic, and I think a lot of people just wonder who stands to gain the most from, gold prices being low, and then, draw those conclusions. But
well, I don't know who stands to gain at all, quite frankly, because
okay.
if the Western governments are idiotic enough to try to suppress the price of gold, and we've got to also make another distinction here. One is manipulation. That word is used interchangeably with suppression, which is incorrect. Suppression means trying to keep something down. Manipulation, well, people try to manipulate everything all the time.
Right.
And so, yes, manipulation goes on by who knows who in all kinds of markets. I'm all for it. We all try to manipulate reality, but that's different from gold price suppression. But if they're foolish enough to be trying to suppress the price of gold, they're not very smart, but they're not so stupid as to realize that they're simply making gold, they're giving gold to the Chinese and the Russians and the Indians at bargain prices.
Right.
Why would they do that? That makes no sense.
Well, you talk about the difference between manipulation and suppression, and there's also, intervention, and that's, coming from the Fed, and we're seeing a lot of intervention in the market. So, what are your thoughts on the U.S. dollar, and is it on shaky ground, and are there any currencies out there that you would invest in?
Not particularly, because and certainly not the dollar. And why do I say not the dollar? Because nobody knows for sure, but there are probably about 8 trillion U.S. dollars outside the U.S. And Americans inside the U.S. have to use dollars by law and tradition, and it's convenient for them to use it. But foreigners don't have to use dollars. And now, with the Russians and the Chinese making this big gas deal, and the Indians trading with the Iranians, and all these governments around the world, all these other countries in the world, don't see a useful purpose in using the currency of a third party, especially if that currency is likely to be a hot potato with trillions of them outside the issuer, and the issuer, the U.S. government, creating trillions more of the things. So they want to use their own currencies. And eventually they're going to wind up using gold because they don't trust each other either. So I really have no interest in any of these currencies. And why hold these currencies with interest rates at artificially low levels? Incidentally, when we talk about suppression and manipulation and so forth, governments would prefer for all commodity prices to be low, and the prices of things like houses and bonds and currencies and the stock market to be high. Okay, that's what they'd like. So of course they'd like these things, and insofar as they issue their own currencies, they've been successful in keeping interest rates low. But that's coming to an end.
Right. Now you've said, Doug, that you buy gold regularly. What else are you doing with your investments at the moment?
Well, I think that about the only thing in the world that's really cheap is the exploration stocks that go looking for the stuff. And right now, I think nobody's interested. Nobody wants any of these junior exploration stocks. Some of them are still selling for less than cash in the bank, so that you get whatever properties and data and management they have for free. So they're at a great cyclical bottom. And as the governments of the world create more currency units, they're going to create more bubbles. And I think one of the bubbles is going to be in mining stocks, especially in these crappy little junior mining stocks. And the potential exists for the market as a whole to go up 10 or 20 times in value, with individual stocks, if they're well chosen, going up 50 or 100 times in value. So I think that's the place to be.
And that's the super bubble that you've talked about coming in gold stocks.
That's right. I think it's going to happen again. We've had a number of gigantic run-ups with subsequent crashes in these junior mining stocks since I've been watching the market, which is sad to say 40 years at this point. And that cycle is not going to end. I think we're going to have the biggest bubble of all coming up, as unlikely as it sounds to a lot of people at this moment.
Now, you've said that people should buy gold for prudence and gold stocks for profit. So does that play into your belief with regards to the super bubble coming?
Yes, it does. Buy gold for prudence, and you'll make good money on it in terms of purchasing power, and the gold stocks to speculate for profit. And there are other things that you should do, too. You should definitely diversify your assets internationally so that they're not all in one country, because the market risks in the world today are huge. But as huge as they are, the political risks are even bigger. So you have to diversify your assets internationally. That's critical at this point because the biggest risks are political. So that means keep your gold abroad in different state places. Own foreign real estate. They can't make you repatriate that if the government puts on foreign exchange controls, either the U.S. or other governments.
And are there any jurisdictions in particular that you find to be more secure on that front?
Well, the whole world is cyclically going in the wrong direction. Most of the governments in the world today are bankrupt, and they're very dangerous when they're bankrupt because their first rule, the first rule of any living creature or organization, is to survive.
Right.
So the government is an entity unto itself, and it will survive by sucking more blood from the thing that it parasitizes, society. So taxes are going to go up all over the world. Regulations are increasing all over the world. There's no country in the world that I can think of that's actually going in the right direction. They're all going in the wrong direction. It's a very dangerous time for an individual who wants to maintain his freedom. But the only way you can do that is being diversified between several different countries, so none of them see you as its own particular milk cow.
Well, I believe you have some property in Argentina. Is that one of the jurisdictions you find to be more secure for diversification?
No, I'm in Argentina. It's a very good diversification, and it's an excellent speculation at this point. The government in Argentina is criminally insane, and they've actually been goofy since the days of Juan Perón in the 1940s. So it's hardly a beacon of freedom. That's the bad news about Argentina. Everything in that country is price controlled or price supported, regulated. The economy is just a mess. But that said, it's a delightful place to be. I love the culture. I love the wide open spaces. It's the eighth largest country in the world with only 40 million people, and they're all around Buenos Aires. So once you get out of the city, it's wide open spaces, and I like that. But from a speculative point of view, everything in Argentina is on sale. Property prices are a tiny fraction of what they are elsewhere. For instance, an apartment in Buenos Aires that you'd pay $20 million for in New York is available for $1 million, a 95% discount. If you want to buy productive farmland, it's half the price of any other place in South America and a third the price of what it is in North America, and it's better land. You've got a cattle herd down there. Cattle have been, they've got all kinds of laws and all this type of thing, so cattle prices are half the world market price. I think the world price of cattle is going to go way up, and the price of Argentine cattle is going to double within that. So I think it's a fantastic place to speculate at this time. So that's why I'm in Argentina.
Okay. Well, we have some excellent questions coming in live from our viewers. So I've got a couple here for you. Our first one, which I think is a very good question and pertinent to our discussion about the gold stocks. B. Kelly asks, will gold stocks hold up when the bear market in the stock markets occur?
Well, that's a very good question because gold stocks are a play on gold, but they're also stocks.
Yeah.
So it's entirely possible, or in fact it's likely, if the stock market collapses, that mining stocks will collapse with it. So I never said that mining stocks aren't risky, especially these little mining stocks, which generally don't even have any gold. They're looking for it. They don't have it. So it's a speculation possibility. At this point, the ones that have cash, which are generally the ones you want to buy anyway, are selling for the price of the cash they have in the bank. So maybe your downside in a market collapse is 50%, but your upside, as I said, is still 10 or 50 to 1, depending on the stock. So the odds are in your favor. Good question, though.
Yes, I agree.
They're risky, no question.
Yeah, I mean, people see the general markets collapsing as being a trigger for gold, which would then set gold stocks off. But if the markets are collapsing, then there might be a bit of lag between the gold stocks, you know, reaching some of those new highs.
That's right. Well, it's the inevitable consequence of these governments sticking their noses into the market. They make them intrinsically unstable. So you can plan your life around financial chaos in the next few years, I think.
Right, it's a safe bet. Our next question is from Salustiano R, and they ask, how high will gold and silver go, and when?
Well, everything's relative. So relative to other metals, to copper, palladium, and platinum, and nickel, and iron, and so forth, I think that gold and silver are reasonably priced. I mean, they've actually done better than any of the other metals since the dollar was the link between the dollar and gold was broken in 1971 by Nixon. So relative to the other metals, they're actually overpriced, not underpriced. But that said, since gold is money, it's cash in its most basic form, and it's much more convenient than holding copper or nickel or other metals, I'm bullish on them. But make no mistake, all value is relative. And relative to other things, whether we're talking wheat and corn or other metals, gold and silver have done much better than those things, and are relatively somewhat overpriced, perhaps. But I think they're going to become relatively even more overpriced in the future.
Okay. And you buy gold on a regular basis, so you know, you think that at current levels people should be buying?
Yes, I do. Because, look, the key thing you've got to remember, if you want to survive in this environment coming up, is you have to produce more than you consume. That's critical. And you have to save the difference. The question is, in what are you going to save it? Now, most people only think of saving in whatever the national currency is, where they live. That's very foolish. I think they should be saving in terms of gold. And remember, there's 7 billion people in the world, and there are probably only about 6 billion ounces of gold. So there's less than an ounce of gold for every human being on the planet.
Wow. Absolutely. Now, just as we wrap up here, we have a last question on capital controls. Do you think capital controls will be something that happens overnight? Will citizens wake up one morning with major capital controls?
Yes, it's like that fool who's the mayor of Chicago, Rahm Emanuel, said a couple of years ago. You shouldn't let a good crisis go to waste. And whenever there's a crisis, the government, any government, never blames itself. It blames somebody else. And that's always an excuse for more rules and regulations and controls. And we already have capital controls here in the United States, but they're very subtle. In other words, there's no law in the U.S. that says you can't open up a foreign bank or brokerage account, but because of what the U.S. has done with things like FATCA, is they've made it extremely hard to do. So trying to find, if you're an American, trying to find somebody who will open a foreign account for you is like finding hen's teeth. So that's one thing. The fact that you have to declare $10,000 or more when you're moving from crossing a border, that's a precursor to it. So yeah, you can plan your life around foreign exchange controls. And if you don't have your money out of the country, you're going to find it impossible or extremely inconvenient and expensive to do in the future. So anybody listening should start diversifying as soon as this call ends.
And Doug, you're going to be speaking a little bit more perhaps on these topics at the Sprott Symposium coming up here in Vancouver in a couple of weeks. Is that right?
Yes, I'm planning on being there.
Okay, and how else can listeners follow your recommendations and advice on diversification and other investment advice?
Well, they can go on Amazon.com and punch my name in there, and you'll find that the two most recent books that I've written, I like all the books I've written actually, and I'll stand by all of them, but the two most recent ones are called Totally Incorrect and Right on the Money. And I think that listeners would enjoy them because I cover a lot of topics in a lot more detail than we've been able to do just in the last few minutes here.
Excellent. Well, I'd like to thank you for taking the time to speak with us this morning, and looking forward to our next discussion we'll be doing at the Sprott Symposium for GoldSeek TV. And we look forward to seeing you up in Vancouver.
I'll see you in Vancouver.
Okay. Thank you so much, Doug.
Thanks. Bye.
Now for listeners, I'd like to thank you all for joining us this morning. If you'd like to replay or share this event, it will be posted on goldseek.com in the next few days. We also have some very exciting GoldSeek TV interviews coming up that we're going to be filming at the Sprott Symposium, a joint venture between GoldSeek TV and Cambridge House Live, and we'll be interviewing Rick and Doug and Peter Spina and quite a few other esteemed guests. So those will be coming out later this month. As a disclosure, members of GoldSeek.com and others participating in today's event may or may not have a position in the securities mentioned in today's webinar. The company may be a sponsor on GoldSeek or other affiliated websites. Thank you all so much for joining us today. Bye for now.